Is the United States on the brink of a historic default?
Today, we're uncovering essential insights from Luke Gromen regarding our national debt crisis.
And you'll grasp the vital points in just minutes, saving you precious time.
Why should we focus on the issue of negative real interest rates? Stay tuned.
Welcome to Financial Insights in Minutes, where we help you stay informed quickly.
We'll also discuss how market complacency could lead to significant corrections.
But first, let's delve into what Luke Gromen reveals about the concerning state of U.S. debt. Let's jump straight into our next insightful summary. The key question is, can the U.S. sustain its skyrocketing debt?
Luke Gromen, a prominent expert on macroeconomic trends, highlights the complex relationship between debt levels and national security in his latest insights.
What is the central thesis from Luke Gromen's revelations?
Luke asserts that the U.S. can only dodge a historic default by maintaining negative real interest rates. If stock prices fall, the nation could struggle to cover its interest expenses.
Let's explore the key aspects. What about the dollar-centric economic system?
Luke warns that the dollar's status is under threat due to excessive borrowing, raising the likelihood of a crisis.
The debt levels are staggering. What could this mean for the U.S. economy?
With national debt surpassing $35 trillion, Gromen emphasizes that sustaining low real interest rates is vital to avoid default. It's a perilous situation.
What's happening on the global stage?
Global central banks, including China and Russia, are offloading U.S. treasuries in favor of gold, signaling a shift in trust. More commodities are being traded in currencies other than the dollar, which pressures its dominance.
What does Luke predict for the future?
He warns about a potential sovereign debt crisis if the U.S. can't manage its fiscal situation. This could lead to a global crisis.
How might inflation affect the economy?
Luke suggests inflation will be strategically used to mitigate real debt burdens, keeping rates negative for sustainability. It's a delicate balance.
To summarize, what are the essential takeaways?
Gromen underscores the urgent need for the U.S. to responsibly manage its debt and ensure the stock market remains strong for fiscal health. We navigate through complex challenges.
But that's not all. Next up, we'll explore what happens to the stock market after the Fed cuts rates.
You won't want to miss Jeff Snider's expert insights into the repercussions of such a pivotal moment.
It's time to explore today's discussion. What is really driving the stock market's reaction to the Fed's recent rate cut?
Jeff Snider sheds light on the intricate relationship between Fed rate cuts and stock performances, revealing unexpected truths from historical trends.
What's the core thesis we're exploring?
The significant takeaway is that while rate cuts are expected to boost markets, history indicates they often signal deeper economic troubles instead. The correlation may just be a market illusion.
Let's break down the critical aspects. What's the latest stock narrative following the rate cuts?
FedEx's drastic decline illustrates that rate cuts do not guarantee market stability. They can reveal underlying economic weaknesses.
What does history tell us?
Absolutely. In both 2019 and earlier timelines, cuts led to initial stock declines, showcasing the market's skepticism about the Federal Reserve's strategies.
How does investor perception play a role?
Investors often misinterpret rate cuts as assurances for rising stocks, when in fact they're usually reactions to economic distress.
What predictions arise from these insights?
Heightened market volatility is likely, as cuts may foretell worsening conditions, making it crucial for investors to remain vigilant.
Any long-term predictions we should consider?
Yes, with the market's increasing reliance on quantitative easing, the immediate effects of rate cuts may be overshadowed by persistent economic hindrances.
To wrap up, what should viewers take away?
Believing in the Fed's ability to stabilize the market is tenuous at best. Rate cuts often hint at vulnerabilities rather than ensuring a secure future.
So, what about the future?
Investors need to be cautious, as the market's reliance on perceived Fed power may lead to unexpected downturns.
But hold on tight. Next up, we've got something intriguing coming your way.
You don't want to miss insights on You Don't Usually See This at Major Tops, featuring none on FX Evolution channel.
Let's dive in. September is notorious as the worst month for markets, especially after a recent 50 basis point rate cut by the Fed. What implications does this hold for the remainder of the year?
Here's the scoop. Recent data suggests potential for significant market fluctuations. Dark pool activity is rising, and option flows are shaping the market at these resistance highs. But are we facing a major reversal?
What is our main thesis here?
The key idea is that although historical patterns suggest volatility in September, the latest positive trends resulting from non-recessionary rate cuts might indicate a hopeful view for the rest of the year.
What's the latest on the impact of the Fed cuts?
Data reveals that on average, rate cuts correlate with a 15% increase in market performance over the following months. This recent cut might spark a positive shift.
And what about volatility in October?
Historical trends show that October tends to be a volatile month. While some sectors may pull back, this can also create valuable buying opportunities for informed investors.
Which sectors should we watch closely?
Consumer discretionary stocks often outperform following rate cuts. Investors must keep a close eye on sector trends to seize valuable opportunities.
What predictions stem from this analysis?
Expect sustained upward movement fueled by increased institutional interest and positive economic indicators. The signs are encouraging.
What about buying pressure?
Increased buying pressure is likely as traders seek dips in stock prices, although volatility may present some short-term challenges.
To conclude, what are our critical takeaways?
Investors should embrace volatility as an opportunity to identify promising investments, particularly under favorable Fed rate cut conditions. Staying informed is vital.
And don't forget, it's all about timing.
Exactly. Awareness of shifting trends will be crucial in recognizing buying opportunities as they arise.
But wait, there's more. Up next, we're turning our compass towards insights from Ted Oakley on markets are too complacent, creating a recipe for pain.
You definitely won't want to miss Ted's sharp analysis on the current market sentiment.
Let's get right into it. The latest discussions around the economy and markets center on concerning trends regarding market complacency.
Certainly, Ted Oakley offers insightful observations backed by over 40 years of experience helping families weather financial challenges. His expertise is invaluable.
What is the crux of Oakley's argument?
The thesis is straightforward. As prices soar and investor complacency increases, we risk facing significant corrections. A false sense of security can evaporate quickly in volatile markets.
What's the global economic perspective?
China is showing notable weakness, while Germany also struggles. Ted highlights conflicting signals from the U.S., with rising consumer spending amid economic pressures.
What about the Federal Reserve's recent changes?
The 50 basis point cut from the Fed is quite revealing. History suggests that such cuts often indicate underlying issues, and Oakley foresees stagflation becoming a real concern.
What's the outlook for debt and inflation?
With debt servicing costs exceeding $1 trillion, interest rates and inflation will be significantly impacted. Ted warns that inflation could erode purchasing power, necessitating a rethink of financial strategies.
Looking ahead, what does Ted predict?
Ted envisions a swift market correction driven by mounting complacency. When fear returns, it could hit rapidly and exceedingly hard.
And what of consumer behavior?
Given a slowing economy, Ted anticipates a rise in consumer defaults. This decline in confidence could trigger a cascading effect throughout the wider economy.
To summarize, what should investors remain vigilant about?
Investors must be alert to market signals. Given current complacency, strategic positioning will be vital to navigate any looming challenges.
But don't go away just yet. Up next, we'll dive into critical market levels that could indicate whether we're headed for a crash.
Stay tuned as insights from Matt will reveal what levels must hold to avoid a downturn.
Let's navigate through crucial insights into market strategies. Today, we focus on pivotal levels that influence trading strategies.
Absolutely. The analysis centers on critical price points traders must monitor to anticipate shifts in market trends.
What is the heart of Matt's market analysis this week?
The core thesis emphasizes that maintaining specific price levels, particularly 565, is essential for sustaining bullish market sentiment. A failure to hold these levels increases the risk of a bearish reversal.
How is the trend structure shaping up?
Though trading remains bullish, cautious optimism prevails due to waning momentum as we approach all-time highs. Buyers must demonstrate strength to sustain positions.
What importance do highlighted support levels hold?
Support at 565 is critical. Falling below this threshold could trigger bearish sentiment, creating significant ramifications throughout trading strategies.
What about volume indicators?
Current volume profiles indicate weak buying engagement during recent upward attempts. Traders should remain vigilant to these trends.
What predictions lie ahead?
Should the market fail to uphold crucial support, a pullback is likely. Traders must prepare for swift adjustments in strategies.
To conclude, what should traders take away?
Monitoring key price levels, particularly 5 and 65, is essential. A drop below this level will necessitate rapid strategic updates.
If you're enjoying these insights, don't forget to hit that thumbs up button and subscribe for updates.
Your support helps us create more valuable content for you to navigate these financial waters effectively. Don't miss out.
As we've concluded today, there are critical insights regarding the looming economic crisis from our expert guests.
Absolutely. Luke Gromen pointed out that with the national debt exceeding $35 trillion, a default might be just around the corner.
That's definitely alarming. Jeff Snider added a layer by emphasizing how the Fed's interest rate cuts could reveal underlying market weaknesses.
Then there's Ted Oakley, who warns that the current market complacency isn't just a red flag, but a recipe for pain.
With all these perspectives, the looming threat to the economy is plain to see. Yet each guest brings unique insights.
If you found value in today's discussion, please like this video and subscribe to our channel for more financial insights.
And don't forget to catch our other content for more ways to navigate these turbulent financial waters.
Thank you for watching, and we'll see you next time.